Ever heard of a PE ratio and wondered what it really means? Let's demystify this common financial term that often pops up in stock market discussions. PE ratio, or price-to-earnings ratio, is a measure of a company's valuation. It's essentially a yardstick that gives investors a sense of how many years it would take for the company to earn back its share price. Think of it as a ticket to a financial future. When you buy a stock, you're buying a piece of the company's future earnings. The PE ratio tells you the price of that ticket in relation to what the company earns. Here's an interesting fact. This metric is a common favorite among both retail investors, those everyday individuals investing their personal finances, and institutional investors, the big guns like mutual funds and pension funds. Now let's get into the nitty-gritty of how to calculate the PE ratio. It's quite straightforward, really. You divide the company's stock price by its earnings per share, or EPS. The EPS is a snippet of information you can find at the bottom of the company's income statement. It's like the heartbeat of a company's financial health, pulsating with every beat of profit or loss. But remember, context is key here. The PE ratio is a relative measure. It fluctuates with the ebb and flow of the stock price and the company's earnings. So it's always a good idea to compare the PE ratio of the stock you're interested in with its peers in the same industry. After all, what's considered a good PE ratio in the tech industry might look very different in the manufacturing sector. However, a word of caution, the PE ratio shouldn't be the be-all and end-all of your investing decisions. It's a quick snapshot, a glimpse if you will, into whether a stock might be undervalued or overvalued. But remember, the lower the number, generally, the better it is for both the investor and the company. So the PE ratio, in simple terms, tells you what you're paying for each dollar that the company earns. It's like getting a sneak peek into the company's financial story, one ratio at a time. Now that we know what a PE ratio is, how do we use it? Well, the price-to-earnings ratio is found within the company's income statement. It's a flexible figure that can change with the ebb and flow of the current stock price and quarterly earnings. So it's important to keep an eye on it over time, not just as a snapshot. One of the most effective ways to use the PE ratio is to compare it with that of other companies in the same industry. This can give you a sense of how a company's valuation stacks up against its direct competitors. Think of it as a financial yardstick, helping you measure relative value within an industry. Now, it's crucial to remember that different industries have different ranges for what's considered an acceptable PE ratio. For instance, a tech startup might have a higher PE ratio than a well-established manufacturing company, and that's perfectly normal. It's all about context. So what's a good PE ratio? Well, that can be a little subjective, but a generally accepted range is between 20 and 25. Anything below that could be seen as favorable, but remember, this can depend greatly on the industry and other factors such as growth prospects and market conditions. The PE ratio is more than just a number. It's a tool that can help you quickly gauge whether a stock might be undervalued or overvalued. A lower PE ratio might suggest that the stock is a bargain, while a higher ratio might indicate overvaluation. But it's not a magic bullet. It's one piece of the puzzle, not the whole picture. In essence, the PE ratio gives you an idea of what you're paying for each dollar of earnings a company generates. It's like the price tag on the future earnings of a company. Remember, while the PE ratio can give you a quick insight into whether a stock is undervalued or overvalued, it should never be the sole or primary factor in your investment decisions. It's one tool in your financial toolbox, not the entire kit. So use it wisely, in conjunction with other financial metrics and analysis. Earnings are crucial to understanding the PE ratio. Let's delve a little deeper. Just like the changing seasons, earnings reports come 4 times a year, each quarter. This regular update can cause the PE ratio to fluctuate, reflecting the company's latest financial health. A lower PE ratio is generally seen as a positive sign for both the investor and the company. It suggests that you're paying less for each dollar the company earns, potentially signifying an undervalued stock. But remember, this isn't a golden rule. Various factors such as industry norms and market conditions can influence what is considered a good PE ratio. This is why earnings are so important. They give us a real-time snapshot of a company's profitability, which directly impacts the PE ratio. So when you hear about a company's earnings, remember it's a key player in the PE ratio and ultimately your investment decisions.